Hello traders, Gary Wagner here, approximately 1:30 in Honolulu, 7:30 in New York on Monday, 29th day of November 2021, and this is the daily report for gold and silver. We had declines in both gold and silver today, and that due to strong bullish market sentiment in U.S. stocks. Also, there was a fractional gain in the dollar index, although it is off the highs of last week. As of 5:40 in New York, gold futures are trading lower, down currently by $2.80. That's 0.15%, and fixed at 1782.90. Silver had a much steeper decline, just over 1%, a net decline of 25 cents on the day, taking December futures to $22.86. Today's decline in both gold and silver were the direct result of a strong recovery in U.S. stocks as well as fractional dollar strength. The dollar gained about 7 points and is currently fixed at 96.17. On today's report, we will focus on the current levels of support and resistance in both gold and silver. We are looking at a daily candlestick chart of gold futures, and while it's obvious that from the beginning of November, this is November the 3rd, that low, up till the 15th, we had roughly a $100 gain. We have given most of that back as we are trading now below the 78% Fibonacci retracement of that rally. However, what we can also say with some confidence is we have seen gold go from a sharp sell-off demeanor to a demeanor of consolidation, and we'll address that in detail during today's show. The key and critical price point that we really need to be aware of is the 78% retracement at approximately 1785. Although gold closed below it, it is only slightly below it today. The 78% retracement is a key and critical area that we need to see gold close back above. Trading has just commenced overseas, and we can see that it is trading above the close in New York, more importantly, above the 78% retracement at 1785. Currently, we have gold futures fixed at $1,786. If we do see gold form a base at this particular price point and move off of it, the key areas we want to look at, two distinct price points. The first one comes in at about $1,800 per ounce, and that is based upon the 50% retracement. This is a long data set that we are using in black. What is in red and then blue is the shorter data set that only accounts for the most recent leg of the rally, and it will be the 61.8% retracement that we will look at as current resistance. In other words, a band between 1800 and 1805, and that will clearly illustrate that gold has found potential support right around 1785, although we've had lows that have come in to the market below that price point. The last 3 trading days have been characterized by fractionally higher lows, although the only higher high we received was on Friday, and that was a exaggerated high as data came out that a new variant was identified in South Africa called Omicron. I do want to convert this daily chart into a weekly chart so that we can focus upon the lower level support trend line, because what happens is when you compress it, what we can see is that on this weekly chart, even though it only represents 1 day of trading, both the open and the close have maintained a price above not only the upper level breakout, former resistance line, but above the key areas that we've been looking at, in particular the 78% retracement right here, and the high comes in just below the longer-term data set's 50% retracement. We've converted our weekly back to a daily chart so I can make the following statement. If we see an effective close tomorrow above 1785, we have clearly indicated that there is confirming data that 1785 is an area of support. Also, we can say that we have resistance between 1799.50 or 1800 and 1804. That is composed of what I call a Fibonacci harmonics, and that's because the 61.8% Fibonacci retracement from the short data set is very, very close in price to the 50% retracement of the much longer data set. Only $4 separates those two price points. So effectively, we have resistance at about 1805 to 1800 here, and we could have support at 1785. If we do not see gold recover and close above this particular price point, meaning 1785, we could challenge 1770, and that is the 38% Fibonacci retracement from the longer data set. The next chart we want to look at is also a daily chart, but it is in Honekinashi or Japanese average format. You can see that on the way up, we had the absence of lower wicks. That's until we had two pivotal candles, these two right here, that indicated that we did have a top, which was the prelude to lower pricing. And when we look at the sell-off, and the best thing to do with a Honekinashi chart is to look at the size of the candles up or down, and in a downtrend, look to see if there's the absence of these upper wicks, because that is key and important when indicating the strength of a trend, and that's what Honekinashi charts do better than any other Japanese technical study. You can see that we had a return. This, of course, is Friday's candle here with an upper wick, and today we had an upper wick. Of course, this last candle is just current trading as it begins to form a candle overseas. What it is showing me that the trend has definitely weakened in terms of the selling pressure, and that there is a decent probability that we will see gold form a base at 1785 and trade higher off of that. Obviously, we need to see how this candle finishes off as the markets move from Australia to Hong Kong, then into London, and of course, New York tomorrow. The last chart that I do want to look at today in regards to gold is the three-line break chart. Analogous to a point and figure chart, the three-line break chart does away with the element of time and only forms a candle when we have a new high or a new low that comes into the market. Based upon this most recent candle that is forming, this type of chart is indicating the potential for a key pivot or key reversal in which the selling pressure has abated and we could see higher pricing. Of course, we have to trade above 1800 to 1805 to get confirmation, because that is where we are currently pegging our resistance at. We are looking at a daily candlestick chart of silver futures. This bases the most active December contract. Over the last couple of months, we have spoken about a basic disconnect between gold prices and silver pricing. However, they both hit a top mid-November, silver at $25.50, and then began a decline. However, the percentage drawdown was a little bit greater in silver than gold. We have added a Fibonacci retracement. It is a data set that begins at the end of September when silver was trading at $21.40 up to the tops achieved mid-November at $25.50. We are looking at trading overseas right now. That's a small green candle, and it is above the closing price that was fixed in New York right here. We really need to see silver break above, I'm going to round it up to $23 per ounce to effectively go back over the 61.8% Fibonacci retracement that occurs 4 cents below that. An effective close above $23 would indicate to me that that will become the next level of support. In terms of resistance, we would look at 23.44 as our first level. That is the 50% retracement. And then $24, which is very close to 23.93. And that number corresponds to the 38% Fibonacci retracement from the data set that we are using from the end of September to the middle of November. If it cannot hold or close above the 61.8% retracement level, the next level we would have to look at comes in at approximately $22.30. That is based upon the 78% fib retracement, and that would be the next level of support. This has been Gary Wagner wishing you, as always, good trading. We'll talk to you tomorrow for the next daily update and review. Bye-bye.